Why your 2026 digital banking strategy is doomed if you ignore the completion and compliance gap. Summary. New research from Boston Consulting Group and Deloitte shows that banks will not win in 2026 with channels and AI alone. The real competitive advantage comes from a completion and compliance layer that turns digital journeys into compliant, revenue-generating outcomes. Every bank is racing to roll out a 2026 digital roadmap with new channels, AI assistants, mobile experiences, refreshed web journeys, and omnichannel buzzwords. Boards are asking for transformation, regulators are raising the bar, and customers are conditioned by big tech to expect instant everything. Yet there is an uncomfortable truth that sits under all this activity. None of it really matters if customers never actually finish anything. If a customer starts a current account application and abandons at the last step, if a small business begins a loan application and never returns, if a cardholder tries to dispute a transaction and gives up halfway through, then your beautiful user interface and your AI pilot have created zero value. What you have is interaction without completion, and in a world of tightening margins and rising regulatory pressure, that is not just inefficient, it is dangerous. Recent industry research does not mince words on this point. Boston Consulting Group, in its 2025 report, Risky Times Innovation in Bank Compliance, shows that leading banks are rebuilding compliance as a strategic engine, not as a back-office cost center. At the same time, Deloitte's Banking and Capital Markets Outlook 2026 makes it clear that the institutions that win will be the ones that turn digital activity into final, auditable outcomes, rather than endless experiments. Compliance is no longer only a cost center, it is a growth engine. The BCG report is explicit that the era of treating compliance as a pure cost is ending. In Risky Times, Innovation in Bank Compliance, BCG outlines how top-performing banks are moving compliance away from after-the-fact controls and embedding it directly into their core processes. Instead of running manual checks days or weeks after an event, they are building compliance into the workflows that customers and staff actually use. Identity verification, KYC, and AML checks, transaction monitoring, and risk scoring. This is not just about avoiding fines, although that clearly matters. Embedded compliance gives banks faster execution, cleaner data, stronger audit trails, and the ability to expand into new products and markets without losing control. Compliance becomes a structural capability that lets the bank move faster without silently accumulating risk. BCG's message is that innovation in compliance can and should create resilience and growth, not just overhead. The only way that vision works at scale, however, is if compliance is wired into the flows where completion happens. A bank can only claim that compliance is a growth engine if every account opening, every loan origination, every payment dispute, and every digital servicing event actually reaches a compliant finish line. A policy that exists in a PDF but is not enforced by the workflow is not compliance. It is theater. Macro pressure is brutal, and half-finished workflows will quietly destroy your 2026 plan. Deloitte's Banking and Capital Markets Outlook 2026 paints a very sober picture of the operating environment. Net interest income is under pressure, margin compression is real, and the search for non-interest income is no longer optional. Banks are betting heavily on fee-based services, embedded finance, wealth management, payments, and new digital propositions to make up the gap. That strategy only works if those digital products actually complete. A 40-step digital account opening journey that loses a third of applicants in the last 5 steps is not a digital transformation success story. It is a silent revenue leak. A slick marketing funnel that drives prospects into a loan process that then fragments across legacy systems and manual compliance checks is not a growth engine. It is a frustration engine. Deloitte also highlights the drag created by fragmented legacy infrastructure and siloed data when it comes to scaling AI, automation, and digital services. Upgrading the core is slow and expensive, yet leaving the core untouched while building isolated front ends simply pushes complexity into the cracks between systems. Those cracks are exactly where completion fails and compliance risk accumulates. Digital experiences do not make money, completion does. This is the uncomfortable pivot that both BCG and Deloitte are pointing toward, even if they phrase it differently. The bank that wins is not the one with the most channels, or the biggest AI lab, or the prettiest mobile app. The bank that wins is the one that can say, with a straight face, that its digital journeys reliably end in a compliant, auditable, revenue-generating outcome. That requires more than a good user interface. It requires a completion and compliance layer that sits between the customer interaction and the core systems. This layer orchestrates the steps that must happen, in the right order, with the right checks and the right data, so that every journey can be driven all the way to finality. In practice, that means real-time identity verification and KYC or AML controls. It means collecting documents, signatures, and consents in a way that a regulator would accept. It means enforcing the sequencing of disclosures and risk checks so that nothing important is skipped. It means generating an audit trail automatically instead of relying on humans to document their own work later. It means integrating front-end channels and legacy cores into a single coherent flow instead of asking customers to navigate the complexity on your behalf. Modernization without ripping out the core. The only realistic path for 2026. Most banks have already learned the hard way that full-scale core replacement is a multi-year, multi-hundred-million-dollar undertaking that rarely lands on time and on budget. At the same time, simply layering cosmetic digital experiences on top of old processes is no longer acceptable to customers, regulators, or investors. The overlay model that both BCG and Deloitte implicitly support is far more pragmatic. Use an intelligent, configurable completion and compliance layer to standardize and orchestrate digital journeys on top of the systems you already have. Let that layer handle the logic of how an account is opened, how a loan is originated, how a dispute is resolved, or how a new product is activated. Let it determine which checks run when, which data is required at each step, and how the final outcome is written back into your core. This approach does not remove the need to invest in data and infrastructure, which Deloitte stresses in its 2026 outlook, but it gives you a way to unlock value in the near term while longer-term modernization plays out. It also gives you a single control point where compliance, risk, and product teams can collaborate on how journeys should work, instead of hard-coding everything into multiple back-end systems. The biggest revenue leak in banking is the invisible gap between interaction and completion. The industry currently spends enormous effort on generating interactions, digital campaigns, app downloads, chatbot engagements, branch appointments that start online and move to physical. Very few banks can confidently show that those interactions consistently translate into completed compliant outcomes. That gap between interaction and completion is where revenue quietly disappears, and where customers silently decide to try a different provider. It is also where compliance risk quietly accumulates when manual workarounds, email chains, and ad hoc exceptions are used to push complex cases over the line. A completion and compliance layer is how you close that gap. It is how you turn the themes that BCG lays out around innovative, embedded compliance and the pressures that Deloitte describes in its 2026 outlook into a coherent strategy instead of a collection of disconnected projects. It is the difference between digital transformation as a talking point and digital transformation as a measurable improvement in completed compliant business. The future is not just AI. It is AI plus completion plus compliance working together. AI will absolutely play a role in 2026 banking, from smarter recommendations to better fraud detection, to conversational interfaces that guide customers through decisions. Both BCG and Deloitte touch on the rise of AI and analytics in their respective reports. But AI on its own does not close a loan, open an account, or satisfy a regulator. It can start conversations, answer questions, and surface insights. It still needs a deterministic, enforceable flow underneath it that guarantees the outcome. That is why the strategic stack for the next era of banking is not simply AI on top of digital channels. It is AI plus a robust completion and compliance layer sitting on top of the bank's systems of record. The AI can engage, explain, and assist. The completion layer can ensure that every journey that should end in a signed, verified, compliant outcome actually gets there. The core can continue to do what it does best, while gradually modernizing behind the scenes. If your 2026 digital banking strategy does not account for that middle layer, then it is incomplete by definition. You may have impressive looking initiatives, but you will still be bleeding revenue through unfinished journeys and carrying unnecessary risk. The banks that internalize what the BCG and Deloitte reports are really saying and act on it now will own the next cycle. The ones that do not will watch customers complete their most important business somewhere else,